Hi there, my name is Nhyira Premium and welcome to our online course in financial management. Now, this is one of the subjects that are fundamental in the ICAG revised syllabus in level 2, and in the entire ICA syllabus, this is the only subject in financial management. In the previous syllabus, we had financial management in level 2 and we had advanced financial management in level 3. But now, in the revised syllabus, we only have this single paper as financial management for the entire syllabus in relation to that. Now, this is one of the subjects that is my personal favorite in the syllabus because of the fact that it is simple, it is straightforward. The syllabus is structured in such a way that you'll be able to apply principles from one area to the other, and you can flip concepts from one point to another in order for you to position yourself to pass the examination. So hey, prepare yourself up and know that this is going to be one of the most interesting papers that you're going to be learning, not only for the examination, but it will make you understand various things about how finance actually work in the world. Now, for those of you who did your MBA for some reason in finance, you might be exempted from this paper, but maybe you did some finance in other courses in relation to that. So there are a couple of things that are going to be a bit familiar here, but we're going to skyrocket, take everything to the next level, and most importantly, making sure that we understand the concepts in that case. Now, in this very first video, what I want to do for you is to take you through the entire syllabus for us to also see the examination structure, look at the key areas we have to focus on, and have an understanding of the entire syllabus in relation to that. What it means is that in this very first session, I'm actually going to complete the syllabus. What are you saying? What I mean is that I'm going to be going through the entire syllabus, breaking down the syllabus, taking you through the various things that you need to understand, why we're going to be learning the topics that we're going to be learning, and how we can structure all of these things out in order for us to understand what we are doing very well in relation to that. So, hey, prepare yourself up. But hey, let me know, what do you think about financial management? What have you heard about financial management? It's always the question that I ask students about it. So, pause the video and then think about it. What have you heard about financial management? Pause the video and think about it a little bit. What have you heard about financial management? In the past 7 years teaching this paper in both the ACCA and then ICA, one of the things I hear from students is that financial management is technical. No. You see, just like financial reporting, where if you are strong in the accounting standards, you are likely to pass the financial reporting examination and by extension the corporate reporting examination. Financial management also has some basic principles, some basic concepts that you need to understand, some basic areas that you need to focus on in order for you to position yourself to be able to pass the examination. And that is what we want to do today in this discussion and see how we can go about it. So you can see on the far right here, we have the syllabus coverage, and then in my immediate right, you see that I have the role of the CFO, the Chief Financial Manager. Now, note that the entire syllabus of financial management is categorized into 4, which we call the role of the financial manager. Now, remember that the financial manager or the CFO of an organization has a role of assisting the organization in order to maximize the welfare of the company. Now, remember, as far as we are dealing with a for-profit making organization, it means that our objective is to what? Maximize the welfare of the shareholders. Now, what does it mean to maximize the welfare of the shareholders? Maximization of welfare of shareholders can come from 2 or 3 angles. Number 1, it can come from giving them high returns on their investments. Okay, so when we say we are maximizing the welfare of shareholders, it's about number 1, giving them high returns on their investments. So for instance, if the shareholders give us $20,000, how much can we give them in return? That is one way we maximize their welfare as shareholders. But not only that, not only are we thinking about high returns, but also if the company happens to be listed, which is where our focus is going to be most of the time, is to be able to increase the share price. Okay? So to increase the share price of the company. So if the company happens to be listed, sometimes it's not about returns, because the returns will be in the form of dividends, But if the company is not paying dividends, which we will get into later on, I'm already excited about it. But if the company is not paying dividend, that means that we need to what? Increase the share price. So what are the decisions we can make as an organization in order to increase the share price? That is the second thing. That is the second thing. So when we say we are maximizing the welfare of the shareholders, I'm using the welfare of the shareholders, but the right word is to maximize the shareholders' wealth. Okay, that is the right word. Maximizing the wealth of shareholders, not the welfare of shareholders. Maximizing the wealth of the shareholders. So maximization of the wealth of the shareholders comes in 2 or 3 forms, like I've said. Number one, giving them high returns on their investments. Number 2, if we are not going to give them returns in the short term, okay, what can we do to increase the share price? That is the second thing. So increasing the share price of the organization. And then number 3 is to minimize whatever risks that their money is going to be exposed to. We minimize risks. We minimize risks. What it means is that we're going to manage the risks, which is something we're going to be looking out for later on in relation to that. So remember, our objective as an organization, for-profit organization, is to maximize the wealth of shareholders. Is to maximize the wealth of the shareholders. When we say maximization of the wealth of the shareholders, what exactly do we mean? We mean giving them high returns on their investments. We mean making decisions that will increase the share price of the organization. We mean number 3, minimizing the risks that we expose their money to as an organization in relation to that. And these things are interconnected. When we pay high returns, share prices will go up. If we're able to manage the risks very well, share prices will go up, we will make more profit as an organization, and we can pay them more returns. So these are intertwined, interconnected. They are not separate, individual on their own, but they are together that we need to look out for in relation to that. So these are the 3 key things that we can talk about when it comes to maximizing the wealth of the shareholders: high returns, increasing share price, and then minimizing the risks that we expose their funds to in relation to that. So having this at the background, meaning that is the role as financial managers. That is what we want to do. We want to find out how can we maximize the wealth of the shareholders. That is our goal, that is our objective, that is our assignment as the CFO of the organization. So to achieve this maximization of the wealth of the shareholders, now remember, we have what we call stakeholders. Just want to make sure that I touch on various things here in relation to that. We have what we call stakeholders, and you learned this in KG2 already, so I'm not going to really go deeper into it here because you know it already, right? So who are the stakeholders of an organization or an institution? In a simple language, we say that the stakeholders are simply the individuals, organizations, corporate bodies, and other institutions that are interested in the operations and the activities of an organization and are affected directly or indirectly by the activities or the operations of the organization. Let's take that again. When we say stakeholders of an entity, we are referring to individuals, corporate bodies, institutions who are interested in the activities or operations of an organization and are affected directly or indirectly by the operations or activities of an organization. These are stakeholders. Now, depending on the school of thought that you have, we have what we call internal stakeholders, external stakeholders. We have what we call internal stakeholders, connected stakeholders, and then external stakeholders. It depends on the school of thought that we are applying, but in general, we can have stakeholders as follows. Number 1, the management or the board of directors. And we're going to be coming to these guys later on in our discussion when we start with the first aspect. Number 2, we're going to talk about the employees of the organization. Number 3, we're going to be talking about the people who give us the money, so the shareholders of the organization, very, very critical. And then number 4, we're going to be talking about the issue in relation to customers. Okay? Number 5, we're going to be talking about the issue in relation to suppliers, bankers, the government, or government authorities or institutions, and all of these things. So all these are stakeholders. Now, this is where the journey becomes interesting. Even though we're looking at the introduction to the syllabus structure and all that, I'm already dropping some bombs that will save you later on in the discussion. These stakeholders, each of them have their objective. So let's take them one after the other. Management. What's the objective of management? The objective of management is to be able to what? Design and implement policies that will be able to maximize the wealth of the shareholders. That's it. The objective of management is that, now we're going to be looking at the agency theory later on, okay? I don't want to get myself into a lot of things here, but there is that agency relationship where shareholders have a trust management with their funds. So management objective is to be able to design policies and put in place procedures, internal controls in order to maximize the wealth of the shareholders. Give them a high returns, increase their share price, or better still, minimize the risks that the fund is exposed to. That is the objective of management. We are not much excited about what management wants. Then we come to the employees of the organization. What is the objective of the employees? The employees are there because they will want what? Better salaries, good working conditions. Not only that, they will also be interested in job security. Alright? Because who wants to work in a company where you are freaked out, you are afraid that there could be job loss or those things in relation to that? Who wants to work in that organization? Nobody wants to work in such an organization. So they also want what? Good salary, good working environment, job security. That is their objective. That is their objective. Now, if it's a manufacturing organization, then they would want to have what? Safety, equipment, helmet, goggles, hand gloves, boots, everything they would want to have, everything they need in order for them to work well in relation to that. Shareholders, we've mentioned already. Shareholders, at the end of the day, wants returns on their investments. This is not a charity organization. We want some money. So their objective is to be able to what? Get their returns, get more dividends, and make sure that their money is not dissipated or used for other purposes. And we'll get into these later on in relation to that. Customers. Customers want have an objective. They would want a quality product or service from the organization at an affordable price with an after-sales services. And they would also want to be guaranteed that the organization will operate into the foreseeable future so they can continue to get the service or the product from that company that we're talking about here. So guaranteeing continuous supply is what they are interested in as customers at the end of the day. Then you come to suppliers. Suppliers are the organizations or individuals who provide the organization or the company with resources, raw materials, and all these things that we need in order to manufacture our products or render our service as an organization. Suppliers are interested to see whether the entity has the ability to be able to pay its debt as and when they fall due, and not only that, to also be guaranteed that the entity can operate into the foreseeable future so that their produce can be acquired by the company so they don't go out of business in relation to that. The reason why this is very critical is that if a supplier has only one organization that is demanding from them, and you get to understand this later on, if they have only one organization that they are selling their products to, what it means is that the company is going to have strong bargaining power on them. What it means is that should that customer or company go into bankruptcy, that means that, hey, you're also going to go into bankruptcy in relation to that. So suppliers will want to see, can this company, they will assess the liquidity of the company to find out whether the company can pay its short-term debt as and when they fall due, and whether they are guaranteed to be able to pay them how much for the goods that they are buying from them in relation to that. Bankers or finance providers. These are the people we borrow some money from, man. So the bank will be interested in looking at our overall profitability as an organization, our gearing level, our financial gearing level, our operating gearing level. We will get into all of these later on in the syllabus, but they are interested in that. Then government and government institution, it depends on the industry we are in. Primarily, the Ghana Revenue Authority is interested in every for-profit making organization, and even not for-profit making organization. If you're a good tax student, you know that NGOs are not subject to tax, but they are subject to tax on their profit-making activities or endeavors in relation to that. So the Ghana Revenue Authority has that interest in companies in relation to that, to make sure that companies are paying the taxes that they are supposed to pay to the government in relation to that. Not only that, if we happen to be a food company, a food manufacturing company, or a food seller, that means that the Food and Drug Authority is going to be after us. The Ghana Standard Authority is going to be after us. Not only that, we may have the National Fire Service or the Ghana National Fire Service also after us, because if you have a well-structured organization, well-structured institution, you should have some fire gadgets in place and all that. So all these organizations are going to be after us in relation to that. If you're a mining company, on top of all these, then the EPA, the Environmental Protection Agency, is going to be upon us. Even if you're a manufacturing company, the Environmental Protection Agency will still be after us as a government organization, as a government institution. Why is that important? Because we want to find out how much toxic gases are we emitting into the atmosphere, and most importantly, how responsible we are in the disposal of our waste, either to the water bodies or to the communities that we are actually operating in as an organization. So that is also there in that case. So all of these, we have students and other stakeholders we can talk about, but all of these are stakeholders. Now, like you can see what I just went through with you, you will realize that each of these stakeholders have their own objective. Now, it is the objective of the organization, management and the CFO to find out how they can actually reach the gap. Now, this is where there is going to be conflict of interest. Why? Because whilst customers want quality products at affordable prices and after sales services, you got to make sure that shareholders get more money on their returns. Because the more you provide quality products to your customers, the more you provide it at a lower price, and the more you do after sales services, yes, you are satisfying the customers, but then you will be using shareholders' money to do that. So you realize that there's going to be a conflict of interest. Employees, they want good salary, good working environment, job security, they want better working conditions. The more you try to provide your employees with better working environment and everything they need to be happy in the organization, it means that the less money will be available to the shareholders. Then shareholders will come after you. Hey, if this year you cannot make this returns, then we are going to liquidate the company. So you want to also satisfy the shareholders. So you realize that almost always there is going to be conflict of interest, because one is looking for this, the other is looking for this, and the more you try to satisfy the welfare of other stakeholders, you will be actually sacrificing shareholders at the expense. The community is also a stakeholder. The community that we operate as an organization. So if an organization is undertaking a corporate social responsibility, whose money is being used for the corporate social responsibility? Shareholders' money. But we didn't employ you to do corporate social responsibility, and you get to understand this later on in the strategic case study in the level 3 paper, where we open all of these things up in that case. But what are we saying here? You realize that to satisfy the welfare, to satisfy the interest, to satisfy the benefits of all the other stakeholders, there has to be a sacrifice of the shareholders' wealth, of the shareholders' money in relation to that. So this leads always to a conflict of interest. It is the objective of the CFO, that is the Chief Finance Officer, and the management of the organization, to be able to find a tune of how far can we go on customers, how far can we go on the shareholders, so that we'll be able to satisfy everybody at a certain point. That is the crux of financial management. That is the headache of management of organizations. That is what they want to look out for. That is what they want to find out. That is what they always want to think about and identify what is really going on. How can we bridge the gap? How can we make sure that yes, we are producing quality products, rendering quality services to our customers at a competitive price or at an affordable price, and we're still rendering after sales services. However, we are not incurring much cost in these things, so that at the end of the day, we can also provide better working environment to the employees, give them good working conditions, pay them better salaries, and most importantly, also make some returns for our shareholders and become a good corporate organization and undertake some corporate social responsibilities. That is the headache of every organization at the end of the day. It is for this reason why you come in as the financial manager to find out how the organization can fine-tune, to find out how the organization can bridge the gap, to find out how the organization can bring all these things together to be able to maximize the welfare of the shareholders at the end of the day. That is what you have to understand about that. So that is the idea. So in a nutshell, what have we mentioned so far? We've said that the objective of the organization primarily is to maximize the wealth of the shareholders. What does it mean to maximize the wealth of the shareholders? Three things. It means that giving the shareholders high returns. It means that increasing the share price of the shareholders, the share price of the company share. And the number three, it means that minimizing every risk that the organization is going to be exposed to so as not to increase the risks that the shareholders fund will be exposed to. But we said that the shareholders are not the only people we're going to be interested in as an organization, but we also have to look at the other stakeholders of the organization, and each of them have their own, each of them will have its own objective in relation to that, but we have to find out how we can bring all these together and most importantly be able to achieve our objective as an organization. You good about that? Let me know if you have any questions. Make sure you put it down, and then during our discussion sessions you can bring that up to me in relation to that. So having understood the stakeholders of an organization and what the organization's goal is, then the big question we ask ourselves is, okay, so how can the CFO, the Chief Finance Officer, now assist the company, help the company in order to achieve the company's objective? This is where the subject financial management comes to be. You got it? So let's go. So the role of the CFO, you being the financial manager of the company or the chief financial officer or finance officer of the company, there are 4 key roles that you're going to be playing. 4 key roles that you're going to be playing as the financial manager to assist the company to do 2 things. Number 1, maximizing the wealth of the shareholders, and number 2, making sure that the needs of other stakeholders are also met. So 4 key decisions the CFO makes. Now these 4 key decisions, like I said, are further bridged into what we see in our syllabus. So like I told you in the beginning, this is our syllabus, the breakdown of our syllabus, and then this is also the role of the CFO. The 4 roles of the CFO is actually into what we call the syllabus coverage in relation to that. So let's go through it in that case. As the Chief Finance Officer of an organization, there are 4 key roles that you play. These key roles are broken down into various topics that we'll be taking one after the other as we go ahead with our discussion. The first decision is investment decision. That is a fundamental decision that we start with as an organization. The investment decision has to do with where can the entity invest its capital? Where can the entity invest its capital? In other words, the investment decision tries to answer the question, where do we invest our money? Now, in trying to answer the question, where do we invest our money as an organization, various things come in. Now, when it comes to making of the investment decisions, these decisions are broadly categorized into 2. We have what we call the long-term investment decisions, the medium-term investment decisions, and then the short-term investment decisions. Sometimes the medium term is ignored to some extent, so I'm just going to deal with the 2, the long-term investment decisions and then what? The short-term investment decision. Now, let's escalate a little bit on the short-term real quick. Now, when it comes to short-term investment decisions, we are talking about the day-to-day. I know you can see that, but it's a short-term decision, okay? I know you can see that, but it's a short-term decision. Now, the short-term decision is has to do with the issue in relation to the day-to-day running of the organization. So this is where working capital management comes to the picture. How much money do we invest in the day-to-day running of the company? Now remember, when we say working working capital, you know this from your financial reporting class. Hey, Nhyira, I did financial reporting last 2 semesters. How do you expect me to understand this? You understand? So working capital has to do with what? Your current assets, CA minus CL, current liability. So current asset has to do with what? Inventory, trade receivables, and then cash. Your current liability has to do with what? Trade payable. So how much money do we have to keep in this in the day-to-day running of the organization? That is where our topic of working capital management is going to come to town. So we realized that from our syllabus covering F is about working capital management, and that is 15% of the syllabus grading. Because whether you like it or not, there is a question waiting for you in the exam hall on working capital management. How much money do we keep in working capital, and how do we ensure that that money is utilized very well to ensure that the organization is run very well? So under working capital management, we're going to be talking about how we manage inventory. So this is where the EOQ formula will come in, economic order quantity issues will come in. What is the total inventory cost? In management accounting, you did that. It's going to come in. How do we manage trade receivables? How do we deal with invoice discounting, debt factoring? All these are techniques of how we manage trade receivable. Cash. How do we keep the cash level? We're going to be using the Miller-Orr principle and then the preparation of the cash forecast or the cash budget of the organization. When it comes to trade payables, do we delay their payments and use the money to run the company, or we can pay them so that we go and borrow money rather from the bank? So we're going to be looking at the cost of bank overdrafts and then the discounts we're going to be losing for not paying our suppliers on time in relation to that. That is a short-term investment decision, and that is about what? Working capital management. That is about working capital management. So that is 15% of the syllabus grading. Very much excited about it. We're going to be expanding on that topic later on, but like I said, it's about looking at the various components of working capital and how we manage those things in relation to that. So we will come back to this later on in that case, but that is short-term investment decision. But our focus also is going to be extended a little bit to what we call the long-term investment decision. So where do we invest our money? Should we launch a new product as an organization? Should we make some investment in R&D, research and development? Should we expand our factory as an organization? Should we acquire some assets, vehicle for the sales department, buy a new software for the accounting department, or buy a new delivery van for the marketing department? Or what assets do we buy? Or should we even go and acquire another business? Okay? Acquisition of other businesses in relation to that, or even merge with some businesses in that case. All these are investment decisions. Now, it depends on the money available to the organization as well as where the organization is at the point of the decision making that they will decide which of these decisions they should go for. So that is where the topic of investment appraisal techniques comes in. So that is our second thing. So under the investment decision, we're going to be doing investment appraisal technique. That is, if we want to launch a new product, we want to do some R&D, we want to expand the factory, we want to buy some assets, these decisions, we would have to what? Appraise those decisions using the investment appraisal techniques. Now, we will get into this later on, but the investment appraisal techniques includes the following methods. We're going to be looking at the accounting rate of return, the net present value, the internal rate of return, the payback period, the discounted payback period in relation to that. So these are the methods that we're going to be using to appraise an investment decision. But remember, all investment decisions will be undertaken if they will maximize the wealth of the shareholder, of the shareholders. So the objective of the organization is that we will only undertake an investment decision if it is going to maximize the wealth of the shareholder. So irrespective of the method that we are using, the objective, the goal, the target is to take into consideration the maximization of the wealth of the shareholder. Very, very critical, very, very important in relation to that. But not that, when we are making the investment appraisal decision, another thing we're going to be taking into consideration will have to do with what is called sensitivity analysis. Sensitivity analysis. You want to stay with me carefully on this because, like I said, this session is about introduction to the syllabus. So I'm going to try to, chop a bit on everything to set you on board as we continue in relation to that. Now, what is sensitivity analysis about? You see, whilst we are making these decisions, okay, using the net present value, the internal rate of return, and all of those things, we're going to be making certain assumptions. We're going to say that, okay, assuming that we sell 2,000 products every year or 3,000 products every year, we're going to be making certain assumptions on even the cost of capital we're going to be using, the inflation rates that we're going to be using, the capital allowance, the cost of the assets, the initial capital outlay, and even when the project is starting. But you see, what if the analysis, the assumptions we use change? What is going to happen to us? So the possibility and the effect on the project, if our assumption changes, is what we refer to as what? Sensitivity analysis. It's what we refer to as sensitivity analysis. So the possibility of a change in our decision is what we refer to as what? The sensitivity analysis. And we'll look at it later on. We will look at what will be the effect on the net present value of a project if, let's say, the initial cost changes. So let's say, for instance, now let me give a weird example here, but you're going to follow it here. So let's say, for instance, I want to marry, right? So let's say that I budget that I want to marry, whatever. Maybe let's say I want to marry in 2 years' time, right? So in 2 years' time, I want to marry. Let's say I said, okay, I want to spend, how much will I want to spend on my wedding? Whatever. Let's say 50K, so $50,000. So let's say I'm spending $50,000 on my wedding. That is what I want to spend. And we've broken this down into wedding gown, ring, suits, everything, event, food, deco, everything. Everything is covered. I mean, it should be covered. This is Nhyira Premium's wedding. You got it? So $50,000. And that is what I do. I said in 2 years' time. So I did it. I realized, okay, it's a